Philip Shaw, Chief Economist at Investec Securities, joins us. Hi, Philip. Some might say that Monty's quite forthright in his views, A, on Spain earlier this week, and B, the fact that he says the European crisis is almost over. Do you think he's slightly exaggerating things?
Oh, absolutely, yes. And Monty's talking a good game here, isn't he? He fully realises that investor confidence is a magic ingredient in helping the crisis to abate. And I think his words last night were very much geared towards that end. Having said that, I mean, the European authorities have managed to lessen the risks of a complete catastrophe over the past few months. The ECB's LTROs worked very, very well.
Yeah.
The Greek bailout's finally gone through, and of course there are moves to boost the firewall. So things are improving, but I do think it's a bit much to say the crisis is over.
On that firewall, a lot is expected, isn't it, of ministers on Friday in Copenhagen. Do you see a scenario, Philip, whereby the funds, the two funds, the EFSF and the ESM, could run concurrently?
I think that's likely to happen now, at least for a while. The Finns have said that they'll play ball with that one. And really the big conversion has been the Germans over the past few months, with Merkel and Schäuble at the beginning of the week saying that they're probably in favour of it. So yes, I mean, that's a necessary ingredient, not just on its own to boost resources, but that should pave the way.
It brings the IMF into play, doesn't it?
Absolutely, yes.
Because on a figure, on a number, it'll be, what, 692 billion if you sort of bring both funds together. If you throw in the IMF, I mean, could you get the firewall over $1 trillion? I mean, is that the minimum where you'd want it to be?
Well, the way we've looked at it is to say, well, look, if you take the 8 most vulnerable countries, really worst case scenario in the eurozone, what are their gross funding needs over the next 4 years? We reckon that's probably about 2.4 trillion euros. If you add up all the various bits and pieces, not just the EFSF and the ESM, but also the other bits of European Union funding, bilateral loans, the IMF, you could actually get something fairly close to, certainly above 1.5 trillion euros, not that far off to 2 trillion. So you're not that far off being able to cope with the worst case scenario.
But you're still saying, yes, the probabilities of Greece leaving the eurozone have diminished, but I think I'm right in saying Investec is still forecasting a reasonable probability of it leaving the eurozone within a couple of years, correct?
Well, that's right. I think the acuteness of the situation has been taken away by the Greek bailout. But if you look at the IMF's arithmetic, really just getting the debt to GDP level under 120% in 2020 is dubious, and that would be the cusp of sustainability in any case. We're talking about a possible need for another 5% fiscal consolidation via spending cuts over a 2-year period. That looks very, very hopeful to us.
Got to ask you about the UK, Philip. We've got GDP data today, the final estimate. The previous estimate was for a contraction of 0.2% in the fourth quarter. More of the same today. What would surprise you if it was much worse or much better?
Well, I think after 5 years of financial crisis, nothing would surprise me these days. But no, we do think that the figure will be unrevised.
Yeah.
Fortunately, the world's moved on. It looks very much as if the first quarter numbers in a month's time will show an expansion of the economy.
So no recession. We've skirted it.
It looks that way, yes.
Yeah. And the key within these figures, I looked at your notes and you say, what financed the rebound in consumer spending? That'll be one of the quirks you'll be watching out for.
Yeah, very much so. Did incomes rise in the fourth quarter? It's not impossible. And what's the state of the household finances, and did the saving ratio fall? So, you know, to certainly the techies, all the economies, that's quite interesting stuff.
We had Miles speak, didn't we? Mr. Miles, one of many say the dubs on the committee earlier this week in America, and he pointed to the spare capacity. He seems to be less worried about inflation. Does that ultimately point to more QE? I mean, you're saying yes, it does, and probably in May.
Well, we think so. We think, firstly, that the Bank of England's GDP projections for next year particularly are too optimistic. They're looking at something over 2.5%, which is somewhere around 1 percentage point more than our own forecast for 2013. I think the realisation perhaps that is on the optimistic side will help the Bank of England to lower their inflation forecast for the medium term. And in our view, with the uncertainties remaining in the economy, probably paves the way for more QE.
And I've got to just ask you about the US and QE, because I note, Philip, that you say it's now unlikely the Fed will stick to its pledge to keep interest rates low through 2014, maybe raise them before that period. Does that mean that QE is off the table or on the table? Because after Bernanke's comments, many are now saying that it's back on the table.
Well, I think the Fed chairman is doing his bit to try and keep long-term rates down by keeping the possibility of QE3 on the table. Certainly, if the US economy continues to perform as it has done, then we don't see any need for further stimulus. And indeed, we do think that the Fed could tighten at some point, perhaps at the beginning of 2014 rather than right through to the end of it.
So you are confident then about this improvement in the job market? You think and you forecast that it will be sustained through 2012? Because he's linking everything to the jobs market, isn't he?
Well, of course, it's still one of the Fed's mandates, isn't it, to keep full employment. So there's a political reason why Bernanke is banging on about this. Our central view is that, yes, the economy will continue to improve, the jobs market also, and certainly the improvement in small business finance and small businesses generally is helping that outlook. But as we know from the financial crisis, things don't move in a straight line, and we wouldn't exclude the possibility that the US economy does run into a problem at some stage, which necessitates more QE, but that's not our central case view.
Okay, Philip, thank you for joining us today. Philip Shaw, their chief economist at Investec Securities.